3 strategies to rule them all. That's what we're diving into today. Ever feel like you're missing out on the really big trades? Like there's a secret playbook that only the pros know? It's tough when you first start out, I know that. But what if I told you there are 3 strategies that can change everything for you? In this video, we're going to break down these 3 killer strategies. We'll start with the strategy 1, then 2, and then we'll end with 3 and how to implement them into your trades. I've personally used these every day for the last year to profit big time. And the best part, I'm going to break these down step by step so you can start using them too. No fluff, no hype, as always, just real strategies that work. Let's get into it. Trust me, you really don't want to miss this one, guys. All right, we are going to start with the intermediate term, shift in structure. This is something that I came up with. You're probably familiar with the first video I did, which I have deleted off my channel. I'll be doing that with any video I think is hurting my channel or not up to par. I'll be removing it and then adding new ones in. So you can look forward to kind of almost a rebranding of my channel, new, better content. I'm constantly striving to be better. Let's get into this now. The intermediate term market structure shift, we're going to look at the bullish version first. Let's say you have a big move down like that. Boom. Displacement takes place, creating a fair value gap right here. And then you see price retrace up into it and it fills the fair value gap. Now it doesn't have to fill it all the way. It just needs to dip into the fair value gap and then leave it, right? That's all that has to happen. Now that high that's there is now an intermediate term high. Now, if you're not familiar with intermediate term highs, all it is a high that fills a fair value gap or some other type of imbalance, which could be a volume imbalance, a gap, just an imbalance in price. To keep it simple, I have gotten rid of ICT's second definition of an intermediate term high because I found it provides us traders with no real edge in price. The algorithm that controls price, really only cares about the ones that fill the imbalances. Once we see this high broken with a close of a candle, that's very, very important to note. It has to be a close. It cannot be a wick above it. It has to close. Be patient because a lot of times you'll see price come up above it and then wick back below it. We want to see a close above. Once we have seen a close above it, that is the intermediate term shift in structure. Once we see this, this will tell us it is safe to go long in a reversal situation. It could have been a run on liquidity. It could have filled an imbalance down here. But the point is that it is now signaled to us that the market is no longer bearish. Why? Because this high would not have failed if it was in fact going to continue lower. Does it work all the time? Hell no. But does it work over 50, 60%? Absolutely. Does it work way better than a swing high that formed here that broke? Hell yes. With the bearish version that we're going to go over now, you would see a really big move up. You would then see that really big move up caused an imbalance to form in price. Expansion phase up pretty much always has an imbalance on lower time frames. And then you get a retracement into the fair value gap. Maybe it wicks around, moves around here, and then goes a little bit lower. And then you finally get the push out of the fair value gap. Now this low here, once broken, will be an intermediate term shift in structure. So then price retraces, closes below it. Now we know that it is safe to go short and the algorithm is seeking bearish draws on liquidity or to fill a bearish imbalance. This video will be broken up into at least 3 videos because each video I'm going to go over each concept individually. I want to give people a chance to watch the video and then study each one. And then by the third one, you'll have the other 2 down and it'll be easy to add it in. Let's look at some examples. All right, this is NQ on the 3-minute chart, which I found out of all the lower time frames, it offers the best win to loss ratio, which is around 60 to 70%. Some days are better than others depending on the price action. Really wicky price action, it's better to be only taking these after a run on liquidity or a high time frame imbalance has been filled. This strategy does work better during reversal times that are naturally in the market, which is 11 a.m., 8:30 a.m., 3 o'clock, and then there's also one usually at around 2:30 as well most of the time. All right, this day is August the 9th. You had a big move down all morning to fill a gap. The gap has been filled. Now there's a big fair value gap here. We will rewind it to right here. Turn on the fair value gap indicator. All right, so we have a bunch of imbalances here. Let's go forward until we get a fair value gap filled. Notice how this one right here, it filled it, but it didn't retrace from it. Okay, so right there, you get a fill of it, but it never retraced and closed below it. It closed in it, violating the fair value gap. That is not an intermediate term high, but that is a violation of a PD array, so it's a bullish sign. Now there you had a move into the fair value gap, a retracement. That is a valid intermediate term high to use for a market structure shift. So we're going to draw a line on top of that. Okay, so once that is broken, that's an all systems go long situation. And see how if you took this long here because it's curling up, it violated the fair value gap. You would have got stopped out if you put your stop below there. That's why we use this, is because it's going to keep us out of the bad trades. Now price is coming back up into it. And that's what I'm talking about. You have to wait for the close. A wick above is not good enough. Another wick above, but not a close, because there's an ITOB right here, right? And that will be the next strategy we're going into. This will offer resistance a lot of times. That's why you need to wait for the close. So there you had your close above it right there. There is a couple different ways to enter on this. If it has filled a RTH gap or a run on liquidity has occurred, in my rules, I allow me to drop down and enter on the lowest time frame possible. But let's just keep it on the 3 minute because I think that's going to offer you the best win-loss ratio. Now we're going to wait for a retracement into this fair value gap here, or a retrace to this high right here. So there would have been a great entry, right? It retraced back to this high that broke, which we probably should have had it on the intermediate term high right there. Let's put it on the close. So this is also what, guys? What is this right here? This is a breaker right here. And then this would be your mitigation block. So price is likely to retrace to the mitigation block. And then there's your entry right there. And then put your stop below this low. And then here was where that ITOB worked for a very good scalp, 40-point scalp or so. ITOBs are great trades for the first couple touches. You get a really great scalp if you pull the trigger quickly. All right, so there's your first example. There's another ITOB working like magic. And then when we go over it in the next video, you'll understand why these two go so well together. So now you had a bearish market structure shift here. You would get out of any longs. I would have sold into strength here, but because this is a consolidation, it's likely to offer resistance to price. Here is a fair value gap that got filled, right, with this down candle. So that would make that what, an intermediate term low. And then there's your market structure shift with the close below it. And then that retracement right here is coming back to what? The mitigation block that is right there. So there's a mitigation block right there. It's coming back to it. There's your entry, short. Then you would target the first ITOB and this leg up. So I think there's a small fair value gap here. Let's check. Yeah, right here. So this down close candle would be your first ITOB. You target that one or one of these two, either that one or that one. Those are where I'd be targeting for price to offer a bounce there. So then you would stay short until you see a break of the market structure shift. So there's your intermediate term high. You don't want to see that break. And then there was a secondary ITOB entry. And then there is your ITOB right here, where you would exit full exit right there. And then price moves back up. All right, guys, that's it for the video. Nice and short and sweet. No fluff, no BS, just keeping it real with you guys. And then if you want to enter into my giveaway, I'm giving away 250K evals. Just like the post, retweet the post, follow my account, and then request a video in the comment below. Like what I mean by that, I mean like give me a video idea and then it enters you into the contest. This one ends on August 21st, so make sure you check it out. And if you haven't checked out my newest ICT Judo Swing, the giveaway is in that video as well. That is a different giveaway. Check out this video, guys. It is straight fire concept I've never shown anyone yet, so check it out. And then if you're interested in funding, as always, check out my website. It's verifiedfundingcompanies.com. I post the best discounts to funding you're going to find, and I have some blogs and stuff like that too. Check it out, and I will see you at the part 2 of the video, which I will be dropping probably tomorrow.